Have you ever wondered how people grow their money through investing while others struggle just to save? For many beginners, the stock market feels like a mysterious place where only experts can succeed, but the truth is that anyone can start investing and build wealth step by step. Today, I am going to take you on a beginner's journey to smart investing. We will break down what investing really means, why you should start now, and how to create a plan that works for you. By the end of this video, you will not just understand the basics, you will have the confidence to take your first steps toward financial freedom. Let us start with a simple question. What is investing? Investing is using your money to buy assets that can grow in value or provide income over time. Instead of letting your cash sit idle in a bank account earning almost nothing, investing puts your money to work. Think of it like planting seeds. If you plant them in the right soil and take care of them, they grow into trees that provide fruit year after year. Stocks, bonds, mutual funds, and real estate are some of the most common seeds you can plant. The key idea is that your money makes more money for you, which is how wealth is built. Now, why should beginners care about investing right now? Because time is your greatest ally. Imagine two friends, Alex and Sam. Alex starts investing $200 a month at age 25. Sam waits until 35 to start but invests the same amount. By the time they both reach 60, Alex has almost twice as much money as Sam, even though they invested the same monthly amount. The difference is not luck. It is the power of compounding. Compounding means your gains start earning more gains, and the longer you give it time to work, the bigger the result. The earlier you start, the less you need to contribute later to reach the same goal. So if you are watching this, the best time to start investing is today. Now that we know why investing is important, let us talk about the stock market. Many people think the stock market is a casino, but it is not gambling when done wisely. When you buy a stock, you are buying ownership in a company. If that company grows, your piece of ownership grows in value too. For example, if you had bought shares of Apple in the early 2000s, your investment would have multiplied many times over as the company grew. Of course, not every company becomes Apple, which is why beginners should learn to spread their investments across many companies. This is called diversification, and it reduces risk. Think of it like this. If you carry all your eggs in one basket and drop it, you lose everything. If you spread them across multiple baskets, one accident will not ruin you. The first step for beginners is to keep it simple. You do not need to pick individual stocks right away. In fact, many experts recommend starting with index funds or exchange-traded funds. These funds pool together hundreds of stocks into one package, so by buying one fund, you instantly own a piece of many companies. It is like buying a fruit basket instead of just one apple or one banana. This way, you benefit from the overall growth of the market without the stress of constantly picking winners and losers. Historically, the stock market as a whole has grown over time, even though there are ups and downs along the way. By investing in broad funds, you ride the general wave of growth without needing to be a stock-picking genius. Another key concept for beginners is setting clear goals. Ask yourself, why am I investing? Is it for retirement, buying a home, or building long-term wealth? Your goal will shape your strategy. For example, if you are investing for retirement 30 years away, you can take on more risk because you have time to recover from market drops. If you are saving for a down payment in 3 years, you need a safer approach with less risk. Having a clear purpose helps you choose the right investments and stay motivated when the market gets rough. At this point, you might be wondering how to actually start. The good news is that technology has made it easier than ever. You can open an investment account online in minutes through brokerage platforms or even apps on your phone. Many of them allow you to start with small amounts of money, sometimes even $10 or $20. The barrier to entry has never been lower. A simple beginner's strategy could be to open an account, set up automatic transfers of a fixed amount each month, and put that money into a low-cost index fund. This process is called dollar cost averaging, and it means you buy a little at a time, no matter what the market is doing. Over time, this strategy helps smooth out the ups and downs. Let us pause here for a quick reminder. If you are finding this video helpful, make sure to subscribe to Financial Freedom Path. I share practical tips to help you manage your money, grow your wealth, and build a better financial future. By subscribing, you will not miss the next video that could guide you to your next smart money move. Now let us keep going. One thing beginners need to understand is risk. Every investment carries risk, but risk is not always a bad thing. Without risk, there is no reward. The key is to manage it wisely. Do not put money into the market that you need immediately for rent or emergencies. That money should stay in savings. Investments are for long-term goals, and you need to accept that the value will go up and down along the way. For example, during the 2008 financial crisis, markets dropped sharply, but those who stayed invested and continued adding money saw their portfolios recover and grow in the years that followed. The lesson is to stay calm, keep a long-term perspective, and not let short-term noise push you into panic decisions. Another mistake beginners make is chasing hot trends. Maybe you hear everyone talking about a certain stock, cryptocurrency, or new technology, and you feel like you are missing out. While it is tempting, this approach often leads to buying high and selling low. A smarter path is to focus on steady, proven investments and only put a small percentage of your money into riskier plays if you want to experiment. Think of your portfolio like a plate of food. Most of it should be healthy staples like vegetables and grains, while the risky investments are like dessert. Fine in small portions, but dangerous if that is all you eat. Now let us talk about patience. Investing is not about getting rich overnight. It is about building wealth slowly and steadily. Warren Buffett, one of the most successful investors in history, famously said that his favorite holding period is forever. That means he buys strong companies and holds them for decades. Beginners can learn from this mindset. Do not expect instant results, but trust that consistent investing will pay off over time. The market will have ups and downs, but if you stick with it, history shows that long-term investors are rewarded. To make this even more practical, let me share a short story. Jenny, a school teacher, started investing just $50 a month into an index fund at age 23. She never stopped, even during tough years when the market dropped. By the time she turned 50, her account had grown into a six-figure portfolio. She did not win the lottery or pick the hottest stocks. She simply stayed consistent, gave her money time to grow, and let compounding do the heavy lifting. Her story shows that even small amounts can turn into something powerful when you invest with discipline. Let us do a quick summary of what we have covered so far. First, investing means putting your money to work so it grows over time. Second, starting early is powerful because compounding multiplies your gains. Third, the stock market is not gambling when you invest wisely and diversify. Fourth, beginners should keep it simple with index funds and clear goals. Fifth, patience and consistency are more important than chasing trends. Each of these principles builds on the others, creating a foundation for your financial future. As a beginner, you may still feel nervous about losing money, and that is normal. Remember that not investing at all has its own risk because inflation slowly eats away at your savings. $1 today will not buy the same things in 10 years, so if you keep all your money in cash, you are actually losing value. Investing is how you protect and grow your wealth so you can reach your dreams. The real risk is doing nothing. Before we wrap up, here is one final tip for beginners. Keep educating yourself. Investing is a lifelong journey, and the more you learn, the better decisions you will make. Read books, follow trusted financial educators, and keep asking questions. You do not need to know everything to start, but staying curious will make you a stronger investor over time. So here is your action step. Take one small move this week. Open an investment account, research index funds, or set aside a specific amount to begin investing. Even a small start is better than waiting. Remember, financial freedom is not built in one day. It is built through consistent, smart decisions that compound over years. Thank you for joining me today on Financial Freedom Path. If you enjoyed this beginner's guide to investing, hit that subscribe button and turn on notifications. In the next video, we will dive into the biggest mistakes new investors make and how you can avoid them, so you can keep your money safe while growing it. You do not want to miss it. Subscribe now and let us continue this journey to financial freedom together.